Hey guys, let me take the noise and turn that into a meaningful soundbite for you. There's obviously a lot of excitement out there with a new US president in terms of the Trump. And look, the big thing for us is probably trying to make sense of his aggressive attitude to global trade. In the last few days, we've seen him put tariffs in with Canada, Mexico, and China. Which is a clear signal that he intends to do what he said he was going to do, which is tariff the hell out of his trading partners until they do what he wants. Now, the concern with that is that his fight against global trade is inflationary. You know, the thing with globalization is that it moved production to lower cost economies and created an almost deflationary world, or at least a world with very low levels of inflation. By bringing it back to higher cost economies, that is absolutely inflationary. And by using things like tariffs and stuff to do it, that's just amplifying that even further. Now, that's inflationary for the US. It's US consumers that will have to pay for that, but it will have downstream impacts. And so it's not good for global growth as a general rule of thumb. It's inflationary for the US, which means interest rates won't fall as far or as fast in the US, which will hold up US interest rates. Higher US interest rates will mean a strong US dollar and will mean a weak New Zealand dollar and a weak dollar for other trading partners. The offset for us is that a lot of our major trading partners are in the same boat. And I think of China in particular, where they've got a weak economy. It feels almost deflationary with oversupply and less demand. And you know, everyone's facing a weak currency against the US dollar. So when you sort of offset those things, my view of it is that we shouldn't have an inflationary impact from that strong US dollar, at least unless it passes through into oil prices, and I think the US will be careful around that. So look, from my perspective, I'm expecting the RBNZ to be fairly quickly moving us back to a neutral OCR, which looks to be around 3%. After this rate fall, that gives us another 75 points to move, and my view is that the Reserve Bank will do that in the first half of this year. We'll get a clear signal on that after the OCR on the 19th of February. If you have a loan at the moment and it's coming off a fixed rate and you're wondering what to do, I would float it until early March and then look to fix in March, but only for short term, 6 to 12 months. Or maybe even leave it on floating that little bit longer, camping out, waiting for rates to get below 5%, which they should do in the next 2 to 3 months. But there's a lot of caveats on that, especially with Trump as president, right? But rates aren't going to get a hell of a lot lower. Certainly don't expect them to get back to the 2 to 3% level we saw during COVID. There's a real risk for all of us that we're sort of anchored on 2 to 3% now being the bottom end of an interest rate cycle. It's just not the case. I think interest rates will sit between 4.5% and 5%, and that's as good as it gets. So then let's take that through to the housing market. Don't expect any silver bullets here. You know, what are the headwinds that are going to drive the actually tailwinds that are going to drive the housing market, right? They simply aren't there. We don't have high levels of immigration. We don't have employment growth that would even make immigration conceivable. We've got a weak economy, weak confidence. And although interest rates are down, they're still relatively high versus what people were experiencing during COVID. So, you know, most people are still adjusting to a higher interest rate environment, and that's not flowing through to consumption. And I don't think it's going to do that this year. So I think 2025 is going to be survive 2025 if you're a business owner. For the rest of us, I think it's going to feel a little bit more positive than last year, but it's not going to be a year to get excited about. I just want to get through 2025, have a good year, and then looking forward to 2026. It feels pretty depressing saying that in January, but in all honesty, I think this is going to be a bumpy year, but better than last year.